Good morning, welcome, and all the best for 2021. We have a lot of exciting and interesting things to cover today, so I'm going to jump straight in, beginning as usual with the surveys. So looking at the Alexander Forbes multi-manager survey, as at the end of last year, you can see the Sygnia funds still doing incredibly well. Across the fund spectrum, from low risk all the way to high risk, and from 1 year all the way to 10 years, performance is number one. Looking phenomenal, and we're incredibly proud of this performance. Digging in to the largest fund, the Signature 70 fund against its multi-manager peers, once again number one across 1 year, 3 years, 7 years, and 10 years. But also still quite a large spread between number one, where we've got double-digit returns, and the bottom of the rank, which is zero. Quite incredible to think that we've managed to get double-digit returns after what happened last year. It's quite a wild ride. And then comparing against the single managers. This is a new slide, and honestly, I could have a webinar all on its own on this slide. What we've done is we've taken the Alexander Forbes Best Investment View survey, and we've tried to find the nearest unit trust offering of each manager to look as a proxy for net returns. Now, there's a lot that can be argued that this isn't exact. You have different timing cutoffs for unit trusts versus other pooled vehicles. You can have slightly different mandate restrictions. So this is at best a proxy. But we wanted to look at net returns because net returns is it's important to you. That's what you get at the end of the day after all costs. And when looking at net returns, you can see that Sygnia is number one across 7 and 10 years, and number two across 1 and 3 years. So on a net basis, our funds are doing incredibly well against the single managers. But what's also very important is to look at the difference between the proxy for gross returns, which is the Alexander Forbes Large Manager Watch, and the proxy for net returns, which is the Morningstar data. And you can see they're not as clear, but if you look at the 3-year number, Sygnia's difference between gross and net, the proxy, is less than 0.5%, and the largest is over 2%. That's a massive difference. And over your retirement contribution period, a difference of 2% can impact your retirement lump sum by 40%. Fees remain incredibly important to the retirement lump sum that you receive. And so it's very important for us to look at not only gross returns, but net returns. So going forward, we'll be looking at the survey, looking at gross numbers and net numbers, but very happy with Sygnia, number 2 over 1 year, number 2 over 3 years, and number 1 over 7 and 10 years. And let's look at 2020 in the review for markets. When trying to make sense of markets, it's always good to look at our mentor, Warren Buffett, who reminds us that the stock market is a manic depressive. And 2020 was certainly no exception to that. And maybe even slightly schizophrenic if you look at the numbers within 2020. So looking at the major asset classes for last year, you can see they're gold, the best return at 31%, next emerging markets at 24%, and then some of the big equity indices, S&P 500, MSCI World up 22%, and at the very bottom, we've got SA listed property down 34%. What's most interesting about this chart is that the returns are quite phenomenal. I mean, you really wouldn't have thought that we had a major recession in 2020 looking at these returns. But when you look within the sectors, you can certainly see that the COVID losers haven't yet caught up. Oil still down 18%. Yes, much better than the -60 it got to, but still down. And financials and property within South Africa still down a lot. In fact, looking within South Africa, you can see that the SWIX only managed to return 3% last year, far less than the global indices. And looking within the SWIX, what's even more frightening is you can see here the Resi at 10, up 21%, versus financials down 20%. So the mirror image, Resi up 20, financials down 20, just showing the huge disparity of SA Inc. focused stocks and the more global growth focused stocks. The Rand also only 5% weaker for the year, which is a phenomenal performance given how weak the Rand got at one point. What's not on this chart, and is equally interesting, is the Sygnia Fourth Industrial Revolution Fund, which returned a massive 69% last year, quite phenomenal. The MSCI Healthcare Index, we launched our Health Innovation Unit Trust towards the end of last year, which admittedly hasn't done as well since launch because the Rand has strengthened pretty much over the last 3 months of 2020. But the MSCI Healthcare Index doing a steady 19% last year. And healthcare over the last decade being one of the top performers. So we continue to believe in this index, even though the short-term Rand strength has hindered it somewhat. Gold, I remain a firm atheist when it comes to investing in gold. And similarly, and there have been a lot of questions on this, Bitcoin. Bitcoin is something that I truly do not understand. Last year in 2020, I haven't put it on this chart because it would break the chart. It did 305%, a staggering number. And a lot of people have asked, my view on Bitcoin, and I'll tell you what I understand, and it is limited. To me, Bitcoin, the closest analogy is gold. There is a finite supply like gold. You mine it like gold. There's a cost to mining it like gold, and it's used as a store of value like gold. As a short-term store of value, I think it's pretty useless. I mean, that is the major point of Bitcoin, is to make transactions. And with the volatility as high as it is, it's certainly no one that I'm aware of is using it to buy groceries. And there's also, because of the long time it takes to confirm the transaction, up to a couple of minutes, there is a chance that people can double spend your Bitcoin. So as a short-term transaction currency, I'm not too excited. Looking long-term, well, long-term it is more similar to gold, and it can be held as a store of value, and that's probably why it has been driven up so much. But it is vastly outperformed gold with much higher volatility. And if you look at that volatility again on a return-adjusted basis, adjusted for the risk, gold still looks more appealing than Bitcoin. But more importantly, at least with gold, you can understand gold is limited to the cost of mining. Bitcoin as well should be limited to the cost of mining. At the moment, to mine Bitcoin costs about $10,000 a coin, with the price is sitting at $30,000, far in excess of that cost. But at least with gold, to me at least, gold has been around for 3,000 years. People know that there is only gold. There's the other precious metals like rhodium and platinum and palladium, but people use gold as a store of value. Bitcoin, as far as I understand, anyone can launch another Bitcoin. There can be infinite Bitcoins. So while Bitcoin itself has limited supply, well, other competitors can be launched. You can basically get gold 2.0 and gold 3.0. So that would be my major concern as to why it is not going to be around for as long as gold over the next 3,000 years. But I've been wrong for over 2020. I was a seller at, not that I held Bitcoin, but I was certainly a seller at 20,000 when it was double the cost of mining. And at 30,000, I would have been a happy short, and it would have been very expensive. So yeah, that's my view. I still don't believe in gold, because I believe gold is seen as a proxy for global bonds, and global bonds have been hurt by, or at least distorted by, quantitative easing, which continues this year. And when growth starts to come back, as it is likely this year, we're going to see yields normalizing, and global bonds and gold are going to be under pressure, as we've already seen this year. The last month, gold is down 5%, and global bond yields are up quite substantially. So we expect more of that to continue into 2021. But the market run this year and towards the end of last year has all been about the vaccine. As Fauci sums it up when he says, absolutely the vaccine is the answer. So let's look at what the vaccine's been doing. So far, 65 million doses in 56 countries have been administered. That was to yesterday. That's a phenomenal amount. 65 million doses have already been administered. The Oxford AstraZeneca vaccine, there are 1.5 billion pre-purchase agreements in place for people. That's 3 billion doses. I mean, it's just incredible the size of this vaccine rollout. And certainly it is going to be by far the largest vaccine rollout in history. The Pfizer-BioNTech vaccine has been approved in North America and Europe and the Middle East as a more expensive and more difficult to distribute vaccine. It is limited to developed markets. China's Sinopharm's vaccine, they're aiming to vaccinate 50 million people by early February, and they're already close to that. Israel has vaccinated 40% of its population. I mean, they're doing an incredible job. Yes, they bought the military, but 40% of their country has been vaccinated. Compared to South Africa, it's a very different story. And of course, this vaccine is once again showing the difference between the haves and the have-nots. Countries like Canada have bought enough vaccines to cover every person in the country 4 times over. Other countries like South Africa are relying on COVAX, which is a consortium backed by the World Health Organization, to hopefully receive some vaccines. And then there's the big uncertainty about the new variant within UK and South Africa and Brazil. And it is amazing what us as laymen become used to. We're now all talking about spike proteins and how vaccines impact antibodies, and all the healthcare lingo is being bandied about. Certainly when it comes to the new variant, it is a risk, but it is a risk that markets seem to be ignoring. Markets keep running and reaching new highs. And listening to the experts, and the experts certainly don't have all the answers, it seems that the vaccines will work on the new variants. They won't be as effective, just as antibodies, while they do work, antibodies from the old strain do work on the new strain, but they are less effective. We're uncertain to how much that difference is and to what extent they are less effective. But Moderna is already working on a boost vaccine for the new variant. And a lot of the experts believe that if it is required, it'll take a couple of weeks for the vaccines to be tweaked to work on the new variant. So to that extent, it is the new variant, while it's a cause for concern, is not a major risk. The biggest risk is just how efficient countries are at rolling out and at administering a double dose vaccination. It certainly comes with a myriad of logistical constraints, but Israel is doing it pretty well. The other good news is that the number of cases, although the second wave has proved to be larger than the first wave, the hospitalizations in the US, at least, fallen to the lowest number in 6 weeks. So that is good news. And lockdowns haven't been to the same extent that they were in the first round. Certainly in the first round of lockdowns, we all realized that we completely misunderstood the virus. We completely mismodeled it. And although the second wave has been as strong from a hospitalization usage rate as the first round, in the first round, we assumed it was going to be at least 10 times worse. And that's why the lockdowns were so extreme in that case. So markets seem to be looking through the second variant and looking towards at least the middle of the year, when we should have a number of the developed market countries vaccinated to the extent that herd immunity should take care of the rest. Emerging markets are going to be a different story, and once again, we're probably going to have to rely on existing herd immunity or self-isolation to get us a bit further. But the vaccine rollout is certainly, we're there. It's being done in an incredible fashion, and markets are rallying as a result. Certainly growth is looking good for 2020 to 2021. I think growth is going to surprise to the upside because of all the stimulus. The vaccine rollout was the first of many pillars that make us positive about 2021. The second pillar is the US. Joe Biden was inaugurated on the 20th of January as the 46th American president, and he's acted incredibly quickly. And he came out to say, we have to act, and we have to act now, and certainly he did. On the first day, on the first few hours after he was inaugurated, he signed to effect 15 executive orders, certainly working incredibly quickly. Most of them to dismantle Trump's legacy, doing incredible number of executive orders to work towards improving climate change, healthcare reform, and stimulus for the economy. So we do expect 2021 in the US in particular to see the clean energy stocks and healthcare stocks looking good, whereas the tech stocks could see some headwinds as a result of antitrust legislation, which could expect. It's not as urgent certainly on his timeline, but it's something he will get to. So the Democrats won the Senate in Georgia in January. That they were once again, the polls got completely wrong. The polls had an 80% chance that the Republicans would at least win one, if not both seats. But the Democrats won. We have a blue wave. And for the first time in 10 years, the White House is held by the Democrats, and the Democrats hold both houses of Congress. And that allows Biden to push through legislation far more easily, as was shown on the first day. And Biden has announced his American Rescue Plan, which hasn't been approved yet. But if it is approved, will once again be the largest stimulus plan in history, $1.9 trillion. Again, these numbers are just staggering. It includes $1,400 of cash into each American's bank account. It's literally helicopter money, printing money. It is an incredible stimulus. So one of the concerns I had about this was that the reason we were so bullish towards the end of last year on emerging markets and world growth was particularly because we thought the dollar would be weak, because there wasn't going to be fiscal stimulus, and so inflation was unlikely to appear in the US. And as a result, US interest rates would stay low for longer, the dollar would stay weaker for longer, and that'd be very good for the rest of world growth, very good in particular for emerging markets. And it was one of the reasons why we were so pro emerging markets. So when we had the blue wave and when Biden announced this $1.9 trillion of stimulus, I was quite concerned that we could see some dollar strength. It certainly will be very good for the US economy. I mean, the US stock market should do well, barring tech, which might see some antitrust headwinds. But it certainly is good for the US and should be good for the dollar and lead to rising bond yields. And as a result, put a bit of pressure onto the rest of the world. However, the Fed Chairman Jeremy Powell came out to say that they're going to keep interest rates near zero until inflation is much stronger. So they're going for the lower for longer approach. And they also said they're not going to dial back on QE until there's substantial economic progress. So basically, the Fed has said that despite all this huge amount of inflationary pressure that we could see coming through over the next 2 years from stimulus, they're not going to act too early. In fact, they're going to act late. And they're going to certainly let us know well before they act, which means the dollar is still going to stay weak and US interest rates are going to stay measured for quite a long time. So the chart on the right is the dot plot for the Fed fund rate. And you can see here 2020 on the left, zero all the way up to 2023. And it's only in the long term, which is well beyond 2023, that we expect the Fed fund rates to tick up. So this really is great news. A second pillar for very strong global growth this year. Not only do we have stimulus, but we've got very supportive monetary policy from the US. So the first pillar is the vaccine, which is being rolled out. And the second pillar is the US, where we have strong fiscal and monetary policy support. The third reason why we're bullish on 2021 is the UK. Boris here says we've taken back control of our laws and our destiny, which is partly true. Like everything Boris says, it's definitely partly true, but there's more to the story than that. But Brexit is done, and that certainly is a positive, and it certainly reduces a lot of the risk for 2021. So we got an early Christmas present, which was great. The Brexit deal was concluded on Christmas Eve, and we're all very, very happy about that. And true, the UK has won a number of concessions. Firstly, they've left the jurisdiction of the Court of Justice of the European Union while retaining tariff-free access to EU goods. Big win. Of course, there have to be customs and regulatory checks, so it's going to slow down the transfer of those goods, but it is a big win. What, unfortunately, they did not win is free movement of financial services. UK nationals require a visa to stay in the EU for more than 90 days. And there is no certainty in terms of how financial services are going to be governed between EU and the UK. And as financial services are the biggest export to the UK, that's certainly very, very important for their outlook. And just anecdotally, we've seen today we had an announcement from the world's largest inter-dealer broker, TP ICAP. They're a London-based firm, and they said that they've been prevented from serving all their EU clients because they haven't managed to move all of their staff to Paris. So until there's certainty on the financial services side, particularly financial services, there's going to be some headwinds to the UK as the big banks and asset managers and brokers are forced to relocate out of London and into Europe to maintain their client base. And there's also still a lot that needs to happen when it comes to the deals. The UK is still going to be in constant dialogue with the EU in the same way that Switzerland has. The UK still has to complete talks with the US and Australia and New Zealand. But the deal is done, which is positive. And what was also positive is that the UK was the first country in the world to start rolling out the vaccine. And the chart on the right is quite interesting. It just shows how the market is looking at the vaccine and how the market is using the vaccine as a proxy for when growth is going to recover. So the white line is the difference between the UK vaccine rollout and the German vaccine rollout. So it's the number of vaccines doses that have been administered. And the blue line is the euro-pound ratio. So you can see here, as the UK has been outperforming in terms of rolling out its vaccine faster than Germany, so the pound has been strengthening over the last month relative to the European Union. So markets are very much focused, not so much on the new variant. They're saying we're looking through the virus, we're looking through the new variant, we're relying heavily on the vaccine. The sooner the vaccine can be rolled out, the sooner life can get back to normal, the sooner growth can recover, and the sooner that your currencies can do well. So it's certainly interesting to see how the market is focusing very much not on the number of new cases, but on the vaccine rollout. Anyway, we're up to 3 positives. We've got the vaccine rollout, 56 million doses. We've got the US with strong fiscal and monetary support, and our third pillar, vaccine, with a strong vaccine rollout, and the Brexit deal at least done, while there are some details that need to be rolled out. The fourth and major pillar that makes us very positive about 2021 is China and emerging markets. Here, Shai is very much focusing on the fact that China continues to open up its economy, but he also spoke at the 51st World Economic Forum yesterday, and basically, said, as China has always said, let's work together, but let's do it my way, or let's do it the Chinese way. And that certainly has been a very successful way up till now. You can't argue in terms of how effective that they have been, even if you don't agree with the methods that they use. The Chinese GDP grew 6.5% in the fourth quarter of 2020. The chart on the right here shows the GDP growth in China. And the Chinese economy as a whole grew 2.3% in 2020 for the year. They're likely to be the only G20 economy to achieve positive growth in 2020. So 2.3% growth in China, GDP growth for 2020, and the only economy to be positive. Quite phenomenal how they achieved that. Yes, they were first into the lockdown and the first out, but they've also managed to manage the lockdown and keep growth going phenomenally strongly despite the lockdown measures that they've had. A lot of that growth has been driven by exports. A lot of it's been driven by the fiscal stimulus that's happening around the rest of the world, and the work from home, which has been driving goods and manufacturing and not services. And as a result, actually, Chinese domestic consumption hasn't been that strong. So we aren't expecting to see the People's Bank of China raising interest rates in China anytime soon. So there should be monetary support continuing there. But the bottom line is we've seen the largest fiscal stimulus in the world in the last 20 years as a result of COVID. We've still got QE being pumped into the world. So we've got lots of monetary stimulus as well. And the other thing that's very good is Biden moving into the presidency. Biden, as I've said before, is going to lead to a far more collaborative global trade policy or US foreign policy, and that's going to keep trade growing, and that's going to be good for commodities, good for China, good for emerging markets. So with the strongest fiscal support in two decades, plus a more friendly global trade policy, it has to be good for emerging markets, and it has been. Commodity prices are close to a decade high, and that has driven emerging markets stock prices up, and it's driven growth up, and it is certainly why we are bullish on the fourth pillar of why we're bullish on global growth for 2021. Strong trade growth, strong commodity price growth, and a great outlook for emerging markets. Why we expect why we are overweight emerging markets, and why we're launching our EM ETF soon. So 4 very good pillars for 2021. We've got the vaccine being rolled out aggressively, the largest vaccination project in history. We've got the US, we're seeing the largest fiscal stimulus policy in history. We've got the UK with the Brexit deal being done and risks being reduced. And we've got emerging markets and China with being supported by good foreign policy and the largest fiscal stimulus in 2 decades. With all that positive background, you can't be negative on 2021. Unfortunately, and as usual, when it comes to South Africa, the best we can say is when everything is going incredibly well around the rest of the world, that our outlook is mixed. And once again, we're not fully participating in the great run that's happening around the rest of the world. Just like we in the commodity boom of the 2000s, late 2000s, we've certainly lagged by volume at least when it came to commodity exports compared to the rest of the world. Here we have our Minister of Health, William Mkhize, saying to deal with the pandemic, the only protection is through the vaccination. Very true, very true. But once again, South Africa, very, 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 very good in terms of setting policy and knowing what we need to do and making promises, and very, very poor when it comes to executing on those policies. We know we need to improve growth. We know we need to cut expenses. We know we need to fix Eskom. We've known that for 13 years. We know we need to roll out the vaccine. But that policy is certainly looking muddled. But there is some good news. As I said, it's mixed. So firstly, our GDP growth in the third quarter beat expectations, falling only 6% year on year. And Tito Mbowene's call to cut 2020 public wages was backed by the Labour Court, saving the South African fiscus 38 billion rand, which is awesome. So that is a positive. Other positives are that our case load, or the number of new cases has dropped from a peak. You can see here on this chart on the right, where we got above 20,000 new cases per day. We're now down to 4,500 cases as of yesterday. So hopefully we can open up the economy soon and save jobs. The other positive catalyst is that we are, and as I've said this many times, we are a small open economy. We're driven by global growth. We're very much commodity focused. So when commodity prices rally and China grows strongly, we do well. And that has been reflected in the rand. The rand peaking at close to 19.5 against the dollar and troughing at close to 14.5 towards the end of last year. So very much the rand being driven by global growth. And our resource index, which once again, it was up 20% last year, it's up another 10% this month, showing how strong global growth is supporting South Africa. Financials being a proxy for SA Inc., down 20% last year, down another 5% this month. Again, a proxy for how South Africa is doing things locally. And it's understandable. So now let's look at the negatives. Well, certainly the vaccine rollout plan has got everybody very disappointed, mostly because there isn't a plan. We're hearing a lot of conflicting numbers. How many doses have been secured, who they've been secured from, what is the price that we paid for them being secured. And I can quote 3 different sources about prices and numbers, and so I'm not even going to bother. But the important thing is we haven't seen a plan. We don't know where we're getting them from. We don't know what we're paying for them. We don't know where we're going to store them, and we don't know how we're going to administer them. I mean, and it's certainly a very, very important question. If you look at how limited our testing has been, and how are we going to achieve a double dose administration of a vaccine to South Africa? And the polls show that 1/3 of South Africans don't want to be vaccinated. So that's another headwind. Even if we do secure vaccines at a good price and we work out a plan of how to do it, well, most South Africans don't believe in vaccination, which is a cause for concern, because what's most important is if you aren't vaccinated, you are effectively a vector and you transmit to other people. And that's why vaccination is important, not because of your own health, but because of protecting everybody else's health. And we've, although we've only managed to secure 1.5 million doses of the AstraZeneca vaccine from the Serum Institute of India, it looks like we're probably paying more than double of the price that the EU has negotiated, because we have been behind the curve. But that's maybe it's good that we are behind the curve, because we don't know to what extent the AstraZeneca vaccine is going to be efficient to the new variant. So there are a lot of questions. Once again, South Africa has to rely on its ingenuity, like we do with load shedding and our herd immunity when it comes to the vaccine. And load shedding reared its head again, unfortunately. We had stage 2 for 5 days in a row in January, which is terrible for our growth. That certainly is the most important lead factor for our growth. We have to have power. Without power, you can't make anything. You can't make anything, you can't create jobs. And not only that, but we have to have a concerted effort or consolidated effort in terms of what we're doing. When the liquor industry has taken our government to court to protect jobs. The alcohol ban is at risk. It's putting at risk 1 million jobs, not to mention huge amounts of excise duties and taxes. And again, although there's been no certainty about our vaccines, the one thing we are certain about is it's going to be paid for by our taxes. And when we aren't getting excise duties in, we need to raise taxes further, which puts jobs at risk, and you end up in this downward spiral. So we need to fix growth. The bottom line is South Africa has had its lowest growth, its lowest decade of growth in its history in 2010. Low growth results in lower taxes. Low growth results in job losses. And what we need to do going forward to fix the revenue side, to achieve debt consolidation, see improved jobs, as we need to create growth, and the most important thing there is not, well, partly fixing Eskom, but it's also sorting out our policy around power supply. I mean, if we could open up our power to independent producers, all we have to do is sign one piece of paper overnight. It changes the ball game. We need to release Eskom from its monopoly for the good of the country. But that's politics, and I don't understand politics, so I'm going to move on. Right now, we are concerned about South Africa's growth until we see a concerted effort. We're hoping that the February budget will be a catalyst, that more structural reforms will be announced at that point. So we remain overweight South Africa bonds because of the yield, and because South Africa is a small open economy that's linked to global growth, and resources are going to do incredibly well, and resources are certainly going to lead to improved growth and improved tax revenues. But until we see structural reforms, the rest of the economy, as is shown by the disparity between our resource index and our financials index, is at risk. So what does that all mean for our portfolios? Well, as I've said, 4 incredibly important pillars that are positive for growth in 2021. Massive vaccine rollout, massive fiscal support and monetary support, good foreign policy, or stable foreign policy, and a stable dollar. Risks are receding, and particularly looking at Brexit. And the 5th one, which I haven't mentioned, is this chart on the right. So the chart on the right shows the amount of cash that sits on the sidelines up to market lows. So looking at equity market lows. So the middle of the chart is 0, and you've got basically 3 months on either side of the market lows. So the white line is the 2001 financial crisis. And you can see there that the cash that was accumulated up to the bottom of the market was about $500 billion, and that was all deployed within the next 3 months. And you can see here for 2009, a similar story. The cash was just over $1 trillion, and that was all deployed. But 2020, the cash on the sidelines reached nearly $2 trillion, and that hasn't all been deployed. So cash on the sidelines and deploying that, particularly when cash is earning such a low return with 0 yields across a number of developed market bonds, that has to be a good tailwind. Of course, there are always risks. As I've mentioned, the new variant is a risk, but also, and again, I've mentioned it, the huge amounts of global debt that are out there. So we've only managed to climb our way out of this crisis, like we did with the 2008 global financial crisis, and Brexit, and the Chinese shadow debt crisis, and Brexit, and the trade wars, by taking on more debt. And once again, this $2 trillion stimulus from the US and all the other stimulus that's happening around the world is stealing from the future and using that money now. So it's great, and 2021 is certainly going to be a good year because of all the stimulus. But at some point, we have to pay back that money, and hopefully that's 2022 or even beyond's problem. So we are positive, but there are always risks, and the next decade we do believe is going to remain a slow growth decade. So what does that mean for our positioning? Well, as I've said, we overweight South African bonds, some of the highest yields in the world, nearly a 6% real return, or 6% in dollars, compared to 0 in Japan, 0 in Europe, or about 1% in the US. We also remain overweight global. So we were very concerned that the rand was too weak, at 19 and at 17 rand to the dollar, and even 15 to the dollar. But when it breached below 15 and touched 14.50, we took off our protection. We had a lot of protection on our dollar positions, and we've now gone overweight for the first time, overweight global. So we've taken our overweight positions to the maximum, and we've deployed that across a number of exciting growth opportunities. The ones that are satellite positions that we always talk about: fourth industrial revolution, where we see good tailwinds, new markets that are gaining market share as we move towards the new normal. Zoom, for example. We also like our healthcare index. Once again, with the huge amounts of R&D spend that has been pumped into the healthcare industry. Not only is it going to lead to vaccines, and not only is it going to see enhanced spending due to aging populations, but there will certainly be a number of positive R&D benefits that are unintended, like birth control and Viagra being the two big ones that we talk about from the past. We also overweight emerging markets globally because of the huge amount of fiscal stimulus, and we overweight the Sygnia Global Property ETF, particularly because that is a specialist property fund, so it's not as linked to COVID losers, but also because we do think that value will have a decent bounce back this year. And certainly value has done nicely over the last 6 weeks or so as the vaccine has rolled out, has been rolled out. Of course, if you overweight somewhere, you have to be underweight somewhere, and we underweight South African equities. Now, this is a tough call. South African equities are incredibly cheap. On a PE basis or price to book basis, South African equities are the cheapest they've been in 2 decades. Well, as cheap as they've been as long as we have data. But we need to see a catalyst to turn that around. Otherwise, they're going to continue to be cheap and be the ultimate value trap. So until we see some positive catalysts on structural reform that we know is going to turn things around, hopefully legislation changes for independent power producers, or Eskom gets past load shedding, or maybe we have some positive surprises out of the February budget. But until we see debt consolidation and the ability to move past load shedding, those catalysts don't exist for us to get bullish on South Africa Incorporated, despite the huge amounts of value. I think if you're very optimistic and you've got a long-term time frame, you can probably go overweight now, but we being a bit cautious and we are waiting. The other thing that's important to note is that markets were very cheap, and they run very hard. In fact, this January alone, the SWIX is up 10%. The SWIX did 3% for the whole 2020. It's up 10% for the month of January. So it shows that a lot of this good news is being priced in. But markets, as Warren Buffett said, are not rational, are manic depressive, and they never go from cheap to fair. They go from cheap through fair and go straight to expensive. And they can be expensive for a very long time, just like they can be cheap for a very long time. So we do expect 2021 for the good news and the rallies and markets to last longer than just 1 month. It won't go in a straight line, certainly, and after a 10% month, we may see a pullback, but we do think that there's more upside to 2021. So that's our outlook for 2021. Hard not to be bullish. Let's look at some of the other things that I promised to look at. See, we've only got 15 minutes left, so I'll try and keep it brief. So this chart looks at wrappers. Now, it looks very complicated, but it's actually quite simple. And all this talks to is we've got the February deadline that's coming up. So the end of February is the deadline for your annual limits when it comes to tax-free savings accounts or your retirement annuities. So if you are doing some investing or you're doing some financial planning, you've got 1 month left to take advantage of some of the tax benefits that come up. So if you do have some money that you need to deploy, or you are able to switch some money before the end of February, please listen closely. Okay, so looking at the left, we have an investment. Let's say you've got 10,000 Rand and you want to invest it into an investment fund. So on the right of the chart, we've got the fund, and I've chosen the skeleton balanced 60 fund, which is invested across equities, bonds, and cash. There is no property, well, there's a little bit of property through the index, but no direct property. But you can use any fund. It can be the Sygnia Money Market Fund, the Sygnia Bond Fund, or the Fourth Industrial Revolution Fund. The fund is irrelevant. The important thing is you've got some money and you want to invest it into the market through one of the Sygnia funds. So how do you do that? Well, there are 4 options. The first is the top line here, where you go direct. So you invest directly into an ETF, one of the Sygnia iTrix funds, or a unit trust, one of the Sygnia unit trust funds. Or you go through a wrapper, and then there are 3 different wrappers to choose from: tax-free savings account, retirement annuity, or an investment policy, or an endowment. And what's very, very, very important is that there is no extra fee. So whether you go direct into a Sygnia unit trust, or you choose to wrap one of that unit trust into one of the 3 wrappers, there's no extra fee from Sygnia. Many of our competitors charge not only for the fund, and yes, there is a fee for the fund. It's 35 basis points for this fund, but many other, plus VAT, many of our other competitors also charge platform fee and a wrapper fee. So they'll charge you for the platform, maybe 20 basis points, and then an RA wrapper fee, and 40 basis points or 50 basis points. So who knows? So you end up with 3 charges. For Sygnia, there's only 1 fee, and it's the fund fee. And that's very important, because even if you look back at that first chart, or the third chart I showed about net returns, that was only fund expenses. The skeleton balanced fund compared to our peers. It excluded platform fees and wrapper fees. So it's very important to know that if you invested in a Sygnia fund, you don't pay platform fees, and there's no additional charge for wrappers. Okay, so you are indifferent from a fee perspective. If you go into a Sygnia fund, you're indifferent whether you pick any of these 4 options. If you go direct into unit trust, there's no limit. So you can put as much as you want to. The 4th column here, no annual limit. But you are fully taxed. So that all depends on your marginal tax rate. So you're fully taxed at your marginal rate. That can be up to 45%, but it could be a lot lower. There are some exemptions on an annual basis, 23,800 Rand on interest and 40,000 on capital gains tax. You generally should hold it for 3 years if you want your holding to be seen as capital gains, not income. Okay, but there are more tax efficient ways of doing it, and that's where the wrappers come in. The most efficient is the tax-free savings account. And talk about a free lunch. This is, from a tax perspective, this is your only free lunch. No wrapper fees and no tax. Tax-free, no lock-in periods. You can put it in today and take it out tomorrow, but you're limited to 36,000 Rand per year and 500,000 Rand over your lifetime. So you've now got just over a month. If you haven't taken full advantage of this, you need to invest in your Sygnia tax-free savings account into whatever fund you want, or switch into whatever fund you want to take full advantage of the tax savings. The second one is the retirement annuity, and once again, you've got a deadline of the 28th of February. Your money in your RA or your retirement annuity, once again, is tax-free on its growth and income until retirement. Once you hit retirement, you do get taxed, and it's even better because it's seen as becoming out of your gross income. You actually can get money back from SARS by contributing. The downside is, because it is retirement focused, you are locked in until the age of 55. So please make sure that you only put money into this wrapper if you don't need it until you retire. And here your limits are 27.5% of your annual income, up to a cap of 350,000. The last wrapper is an endowment, and it's an individual. That's called it's an IPF endowment. And here it's only really relevant if your marginal tax rate is higher than 30%, that's what you taxed at, and your marginal tax rate is higher than 12%, which is your CGT. So if you are investing in a unit trust and you're hitting your marginal cap of 45 and 18, and you don't mind holding money for 5 years, well, then you can use this wrapper and get your instead of paying the marginal tax rate, you can get it down to 2/3 of that roughly. And again, no additional fee for wrapper fee for that. So those are your options. you've got until the 20th of February to take advantage. If you do have money that you want to invest, certainly take advantage of a tax-free savings account. If you're not certain about your time horizon, and if you are certain you can hold the money until retirement, then take advantage of your retirement annuity. I'm sure there are going to be lots of questions on that, but I'll take questions afterwards. The other thing I want to remind everyone about is our very exciting ETFs that we're launching at the end of February 2021. We've got 3 ETFs that we are launching. The first is our S&P Global 1200 ESG. So this is very exciting. Firstly, it's ESG focused, so it's got S&P's ESG overlay onto it, which is very important and certainly will help choose companies that are more resilient for the long term. That also, while it's quite close to our existing MSCI world, it's actually more close to the MSCI all country, because it does include an emerging market aspect. And we're very bullish on emerging markets going forward. So if you do want some emerging markets, if you want the all world equivalent of MSCI, S&P Global 1200 is that equivalent. And it's at a great fee, certainly one of the lowest fees in the market, with a target TER of 35 basis points. So if you're looking for the most diversified and global index that has an ESG overlay and includes emerging markets at a great fee, you can't get better than this product. We're also launching our MSCI Emerging Market 50 ETF. It is one of our satellite portfolios that we think emerging markets has with structural tailwinds. This in particular, we've chosen the MSCI EM50 because it's got the largest exposure to China and Asia, ex-Japan emerging markets. So it's got close to 85% exposure to Asia, including China, and over 50% exposure to China. So if you are bullish on China, if you are bullish on Asia, ex-Japan, then this is certainly a great vehicle. And lastly, we've got, in conjunction with our Health Innovation Unit Trust that we launched towards the end of last year, we're launching the similar health ETF, the Sol Active Health Innovation 150. This targets, it's a passive ETF targeting the top 150 by free float market cap healthcare companies. And we certainly believe that healthcare has great structural tailwinds because of the massive amount of R&D spend that's currently happening because of aging populations, that you will see a lot of demand for healthcare stocks going forward across the spectrum. Drug producers, pharmaceuticals, hospitals, diagnostics, vaccines, it's all going to see enhanced usage going forward. Yeah, so three great opportunities that we see and we will be launching quite soon. And the final slide for the webinar this month, so we are running out of time, is just to talk about our zero management fee fund. So another Sygnia first, when it comes to Sygnia being a disruptor, we're trying to encourage people to save by making investments even more accessible. And we're doing that by offering 2 funds at zero management fee. Firstly is the Sygnia Money Market Fund. So you could earn a yield of 4.2%, which is far in excess of what you can earn in the bank, and you're not paying any fees. Or you can put money into the Sygnia All Bond Index Fund and earn 8.7% yield, which is incredible. You know, our bonds are amongst the highest real yields in the world, again for no fee. So I have to say that there are no smoke and mirrors here. There's zero management fee. There's a very small TER to cover some of the trading expenses. So you will see a TER of maybe 3 basis points. But Sygnia is earning nothing. In fact, Sygnia is paying some of our external providers out of nothing. So we're running this at a loss. And we are doing this to make investments more accessible. And we do think this is a phenomenal opportunity. So please do take advantage of it. If you want to put money in the bank, the money market fund gives you probably an extra 70 basis points. Or if you can take on a little bit more volatility and you want a higher yield, then the bond fund is a great opportunity. So how does this work? It applies to all existing investors. So if you're currently invested in the Sygnia Money Market Fund or the Sygnia All Bond Fund, from the 1st of January this year, you stop paying management fees. And if you're a new investor, up till the 30th of June, so if you invest in the fund up till the 30th of June, any new investor coming in up to the 30th of June, along with all existing investors, won't pay any fees until the end of 2022. So if you join on the 30th of June, you've got 18 months of no fees. If you're an existing investor on the 1st of Jan, or you invested on the 1st of Jan, you've got 2 years of no fees. If you join today, you've got 23 months of no fees. So a really, really exciting opportunity, a first to the market. And I really encourage anybody who if you're looking now to invest in your tax-free savings account and you're not quite sure what you want to do with that money, well, the lowest risk portfolio is the money market fund, and then your next low risk fund on your efficient frontier is bonds. So that's looking at a great yield. Of course, if you've got a longer term time horizon, you can include some equities, and the amount of equities will depend on your time horizon and your risk. And then look at other funds for your TFSA or for your RA. Okay, 3 minutes left. Sorry that took so long. Let me see if I can get to a few questions. Yeah, so again, just for some clarity, there has been, because we've hit our SARB limits, there has been a limit to certain investments through living annuities. However, any direct investments into our unit trust or into our ETFs, you can have 100% global. So if you want to invest in the 4th IR or S&P 500, it's unlimited on the ITRIC side for the ETFs, and it's unlimited on the unit trust for direct investors. But if you are coming in through a living annuity, you will be limited to 30% global, and RAs are already limited to 30% global by regulations. Garth says Bitcoin is gambling, not investing. Garth, I do agree with you. With volatility like that, I don't know how anyone can call it investing. FANG portfolios have run hard. Yes, thank you, Richard. We are underweight FANG across our balance funds. We still got exposure to 4th Industrial Revolution, but we are underweight FANG because while we structurally believe it's a great place to be, there's great platform companies. Apple gets 30% margin on any spend on platform spend. And it's a great business model, but they have run hard. And more importantly, we could see some headwinds from antitrust legislation. Biden is very focused on that. And yes, he hasn't done anything yet. He's got more important things to deal with, but in a month we could see renewed focus on antitrust legislation, which will certainly be a headwind to FANG prices. And we saw what happened in China, and we saw what happens in Nasdaq as a result. The moment the Chinese government started talking about antitrust legislation and breaking up Tencent and Alibaba, those stocks fell dramatically. Lockdown certainly has got a big impact on property stocks, and particularly in South Africa, and particularly in the UK. And not only the lockdown, but the services part of Brexit. If there isn't a negotiation soon, and we see some forced moves of head offices, the dual headwinds of, well, there's going to be certainly less tourism. going forward until the vaccine is rolled out, so probably at least a year for tourism, which is bad for London in terms of high street, and long term with big finance companies being forced out of, or if they are forced out of London, that's also bad. So there are certainly two headwinds to UK property. Daniel asks, in terms of economic growth, would you say that emerging markets are facing larger headwinds in the next 2 years compared to developed markets? Should we be wearing of EM in the short term? No, I think that on the one hand, so you've got to look at the makeup of emerging markets. Emerging markets are primarily China, and then they're Asia, ex-Japan, and a very small portion of emerging markets is Russia, Brazil, and South Africa. So the one downside is that emerging markets are going to, well, when it comes to Brazil, Russia, and South Africa, and possibly India, it's going to be a slower rollout of vaccines than developed markets. But China in particular and is rolling out the vaccine very rapidly, and all emerging markets do very well because of commodity prices rolling and the fiscal stimulus. So I do think that the emerging markets are going to have a strong tailwind over the next 2 years. Alan asks if there's been any updates on Reg 28. Still nothing. Although we did sit on I sat in on a BAT-CETA conference towards the end of last year, and they do represent retirement funds. And what was interesting is that it sounds like there's going to be a very strong self-regulation of retirement funds, to the point where BAT-CETA is going to encourage not merely prescribed assets, but encourage trustees to invest in a good portion of infrastructure funds. Right now, it's still very early days. We don't even know how to define infrastructure, and we don't know what that allocation is going to be. It might be as low as 1% or as high as 5%. We aren't looking at prescribed assets, but there could be some very strong peer pressure for trustees to make sure that we include infrastructure. And certainly at Sygnia, we are working very hard to get our infrastructure fund up and running so that we are ready when there is some clarity on the outlook there. Yeah, looking for questions that I haven't answered up till now. Just on, so this, again, without going into detail, but the zero fee funds on the money market is limited to the retail fund. If you are in our institutional money market, you do not get the zero fee. However, there are different regulations that apply to retail and institutional. Institutional, by its nature, has a longer term time horizon and has got a wider mandate. So if your pension fund is invested into institutional money market, you are going to get a better yield even after fees than through a unit trust without fees. So please don't be concerned about that. There's a reason for that. Firstly, the institutional fees are very, very low. And secondly, there is different legislation. So please contact us if you want more details. But if you're an institutional investor in money market, you're better off staying where you are. So don't stress. Money market and bond returns, unfortunately, those aren't guaranteed. So right now, the yield on money market is 4.2% roughly. That actually should go up. We are expecting towards the end of 2022 for interest rates to finally be increased. So that 4.2 should be roughly that for the next year, and then towards the end of next year might actually go up to 4.5. Bonds are influenced by the volatility of bond instruments, and so you could actually have some capital gain on that in the short term, but there could be some capital loss in the short term. But if you hold it until maturity, you're guaranteed of that 8.7%, but that maturity is, can be up to 10 years. Yeah, unfortunately, we don't have a timeline on when we're going to open up, or when we get to when the SARB will allow us to open up to more than 30% for living annuities. The limit is 40%. We're sitting at 42, so hopefully it shouldn't be too long. Maybe 3 months, maybe 6 months, and we'll get our 42 back down to 40, and then we can open up to the rest of the market. So a very good question that I have to answer in the past, but the chances of SA bonds defaulting, SA bonds by their nature cannot default because the government owns a printing press and the majority of our debt is in rands. On the other hand, as a true economist, you can get to the point where you're in a debt spiral where you end up spending all your money on paying interest, and you have to issue more and more debt. And the most likely outcome there is that South Africa will print money to get itself out of debt. You won't default on your bonds, but the rand will weaken considerably. So your only defense there is taking money offshore. If you've got your money in South Africa, then your best bet is SA bonds. Within SA equities, we still prefer the SWIX to the cap SWIX, mostly because it has a larger global component, and it has which was achieved through Naspers and Prosus and Tencent, which gives you exposure to Chinese growth. So we do like that. When it comes to the various indices, you can look at the All Share Index, the SWIX Index, the Cap SWIX Index, the Cap SWIX 640 Index, and the top 40 index. So in terms of getting the largest global exposure, your two best bets are the SWIX 40 and the top 40, both of which have more than 30% exposure to Naspers. So those are your best exposure. If you like resources, then choose the top 40 index. If you prefer more financials, then go for the SWIX 40 index. We should have some information out on these ETFs that we're launching soon. Because we're launching at the end of February, we should have some information out in the next week or two. And yeah, that's all the questions that we seem to have time for. So being flagged is now 10 minutes over time. So thank you very much for joining. I hope it's been useful. And good luck for 2021. It should be a better year than last year. It's certainly started off as a great year. Yeah, until next month, keep well.